Hello and welcome. This video today will show how Smart Start workforce grants and other grants affect your taxes. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. In today's conversation, we will discuss how to recognize key relief programs and their general tax implications, identify the general impacts of relief programs on tax filings, and how to use this information as a resource as you prepare to file your taxes. This information is intended to serve as one of many resources in your toolkit. It is not a substitute for, nor should it be construed as, personalized advice from a tax preparer. Both the state of Illinois and the United States federal government dedicated many resources to support child care programs through the COVID-19 pandemic. Relief funding saved many businesses from permanent closure, perhaps even your own. Following the Illinois Child Care Restoration Grants, Strengthen and Grow Child Care Grants, and Smart Start Transition Year Grants, Smart Start Workforce Grants offer child care programs stable, ongoing funds that are needed to cover costs and invest in quality staff without burdening families by raising tuition or child care assistance program, CCAP, copays. Eligible programs receive consistent funding in advance, and funds will cover the cost of higher wages and operating a classroom. Programs receiving these grants will be required to pay classroom staff a wage floor, regardless of performance. These competitive wages will help to attract more staff and meet parents' needs at a rate that they can afford. While these relief funds were highly needed and well used, many child care business owners have wondered how this funding will affect their taxes. Different relief funding programs will have varying impacts on your federal and state taxes because funding sources are governed by different tax laws. Smart Start workforce grants provide funding to cover payroll increase costs you will soon implement to meet the wage floor. Consequently, you must report the funds as income on your federal taxes in the year that you receive the payment. This means that the federal government will tax your grant money at your federal income tax rate. Because you will need to pay taxes on Smart Start workforce grants, your tax bill will most likely increase. However, this can be offset by claiming expenses paid for by the grant as a business deduction. Let's look into the upsides of Smart Start workforce grants in the tax process. First, federal taxes on relief funds do not affect how greatly you are taxed on your earned income. The additional tax money you are paying is being taken out of the funds you receive from the grant. Second, expenses covered by the grant continue to qualify as a deduction. Let's look at an example case. Ashley was eligible for Smart Start workforce grants, and she received a total of $5,400 in support in 2024. As required, Ashley allocates the money to her qualifying 2024 payroll expenses. When Ashley does her 2024 taxes, she can still report payroll expenses. They qualify as eligible deductions. This means that Ashley is reducing her tax burden by deducting eligible expenses, even though those expenses were paid from Smart Start workforce grants rather than Ashley's earned income. Ashley's 2024 earned income is $40,000. As a single filer in 2024, Ashley would owe the federal government $8,581.10 in taxes if she did not receive a grant. However, Ashley needs to add the additional relief grant she received to her income. Ashley adds the $5,400 in relief funds to her taxable income. Now, Ashley's total income is $45,400. Since Ashley is in the 22% federal tax bracket, she is taxed an additional $380.82 on the $5,400 relief grant, which increases her federal tax bill from $8,581.10 to $8,961.92. Although Ashley's federal tax bill did increase by $380.82, Ashley was able to directly put $5,019.18 of Smart Start Workforce grants funding toward her payroll expenses. Ultimately, Ashley ended up with more money than she otherwise would have and was able to reduce her tax burden using relief-funded deductions. The receipt of Smart Start Workforce grants funding allowed Ashley to help her business and her family. There may be circumstances where you receive Smart Start Workforce grants funding in a tax year, but the amount of increased payroll expenses are not incurred until the following tax year. Because Smart Start Workforce grants funding cannot be used for back pay, there is the possibility of receiving funding in one tax year and then incurring the expenses the following tax year. In this instance, you would pay taxes on the grant funding in one tax year, but take the expenses on your taxes the following year. Let's look at an example on the following slide. Let's revisit Ashley using the same amount of Smart Start Workforce grants. If Ashley receives the $5,400 in Smart Start Workforce grants the last quarter of 2024, but does not implement the payroll increases until 2025, she will not have the corresponding increased wage expense in 2024 to offset the taxes on the grant funds that year. In this instance, Ashley will pay the increased tax bill of $380.82 with her 2024 taxes. She will, however, be able to claim those expenses on her 2025 taxes after she has implemented the wage increases, thereby lowering her 2025 tax liability. What action should Ashley take regarding this increase in her 2024 tax liability? A smart practice would be to set aside $380.82 in an account for use next year when she files her 2024 taxes. By planning and depositing the money in an account until next year, Ashley will be prepared to address the higher taxes. You may have received the Employee Retention Tax Credits, ERTC, and/or the Family's First Coronavirus Response Act, FFCRA, credits to help reimburse payroll expenses that you maintained while your business operations were impacted by the pandemic. Both the ERTC and FFCR are refundable tax credits meant to offset wages that your business paid out from the time period of March 15, 2020, through September 30, 2021. Businesses have 3 years from the time the original taxes were required to be filed to claim the credits. This means that businesses were able to file 2020 claims up until April 15, 2024, and will be able to file 2021 claims up until April 15, 2025. Many business owners are not aware that funds received from the credits are taxable and will be included in your gross income for federal and state tax purposes. It is recommended that you consult with your tax professional regarding these tax credits when preparing to file your taxes. If you receive these credits in 2024 or early 2025, it is advisable to set aside a portion to offset the additional tax liability you will incur. If you received in-kind gifts of tangible supplies rather than money to buy the supplies, you most likely will not face a tax liability. Consult with your accountant or tax preparer to determine the best way to record the donation. If you received pandemic relief funds or Smart Start Workforce grant funding, they likely have been, and will continue to be, critical to your childcare business's financial operations and recovery. Even though this support can increase your tax liability, the new income that it offers you is valuable. The best way to prepare for this taxation is to organize your expense documentation, such as receipts and payroll, and differentiate the sources of income used to pay for your potential deductions for federal versus state purposes. This is because what you are allowed to deduct may vary for your federal versus state tax filings. You should then set aside an amount of funds equal to your marginal tax rate so that you are prepared to pay any owed tax. If you are unsure, you can use 22%, which is the most common tax rate in the U.S. For more child care business tax resources, visit www.civstrat.com/taxes. Do you have any questions? The Illinois Network of Child Care Resource and Referral Agencies, INCCRRA, will administer the Smart Start Workforce grants. INCCRRA will provide technical assistance answering technical questions and helping with the application process through its website and via email. Email grants@inccrra.org with questions. New to Smart Start Workforce Grants is local technical assistance through the Local Child Care Resource and Referral (CCR)NR system. This will provide local grant experts to provide technical assistance and answer questions. Find your local expert using the QR code on the screen. And be sure to visit the Civitas Strategies YouTube channel for more valuable resources to support you and your business.